Great. Okay, well, thanks everyone for attending tonight. It looks like there's over 200 people dialed in this evening, so appreciate the interest. Now, over the next 15 minutes, we'll cover Shanta, we'll cover what we're doing in East Africa. On the line with me is Luke Leslie, the CFO of the company. Just to introduce us as we kick off, Luke and I have been working together for the last 14 years. We've had a lot of experience in different opportunities, and we are shareholders of Shanta. We're meaningful shareholders, as is the board. Over 9% of the company is owned by the insiders, and we are aligned with the shareholders. It's personally my single biggest investment is in Shanta, as on a personal basis, and we are motivated by shareholder return. Now, in terms of Shanta, Shanta may be familiar to many of you, but I'll give you a quick recap, and I'll tell you about why we think this is an interesting time, particularly to be looking at Shanta. 85,000 ounces of production last year at an all-in sustaining cost of $777 an ounce, generated just under $50 million of EBITDA. We are an East African gold producer with a very exciting portfolio of two projects, especially being Singida and the West Kenya project that we just announced in February. In terms of what we do well is we are an underground miner. We are a low-cost underground miner, and we have a very high-quality suite of assets. Now, when you think about Shanta, as you can see on this page, we're capitalized at just over $100 million. And when you think about the cash generation that we create from our single mine at the moment, 48 million, that was on last year's gold price of 1377. I might remind you that our Q1 cash flows were 15 million, so annualized that's $60 million of cash flow against the gold price of 1414 in the first quarter. And on a spot basis, we're generating $70 to $80 million of EBITDA at the current gold price of about $1,700. And that's all against the market cap of, like I said, just over 100 million. We really believe, and we'll take you through the upside of the projects that we're excited by. We really believe this is $300, $400, $500 million company in terms of valuation. Has a lot of room to get there. Now, in terms of what we own, before I hand over to Luke to take us through the West Kenya project, the new Luika gold mine is our single producing asset at the moment. It's been in production for 8 years, and as it generates today, $48 million last year of EBITDA, 85,000 ounces of production, and it is our cash cow. It's the foundation of Shanta. Now, the good news is that every year, New Luika will generate roughly about the current cash flow of about $70 million on the spot basis, which is not too far off our market cap. So every year you're getting a market cap thereabouts replenished on the current valuation. Last year, we extended our mine life by over a year, and this year we have that target in place as well, and it's going on track so far. Singida, a project you may or may not have heard of for many years. It's been in our portfolio for a while. We're excited by it because in January we announced an updated an updated resource base for Singida, just under 1 million ounces at 2.25 grams per ton. What we've said is before the middle of the year, and possibly this month, we will be updating the Singida project for reserve estimate and for economics, because the last time we did that was back in 2018, and we believe that things have gotten significantly better at Singida, and we've said that already. So we're excited by it. Singida could be put into production in 18 months or less, according to the numbers we're working on at the moment, and would take us to 115,000 ounces of gold production on a consolidated basis. That is very significant, and at these gold prices, will generate north of $100 million of EBITDA per year. So stay tuned for Singida. It's on the way, and we've publicly said that already. Now, in terms of the growth project, this is where things get incredibly interesting, because this is a project that hasn't been in the public space in its entire life. It's been holed up as a non-core asset in a major gold producer since it was discovered. Now, the good news is that we've announced to acquire the West Kenya project back in February. Luke will take you through the details, but the headline figure is 1.2 million ounces at 12.6 grams per ton. Simply extraordinary, really, and understood to be known as one of the highest, if not the highest grading 1 million plus ounce gold project across Africa. At the end of the call, I'll take you through the catalysts of what to look forward to on that. But without further ado, I'll hand over to Luke to take us through a bit more on how we got there and a bit on the project. Luke.
Thank you, Eric, and good evening, everyone. Shanta is in a very strong position to enter Kenya, and I'll take you through some of the background to that. We've spent the last 3 years at Shanta improving efficiencies at our new Luika mine there and repairing the balance sheet. Shanta's USP is long hole open stoping. We don't think that there are many other companies out there who can compete with us on a cost per lateral meter basis. We also happen to be one of the safest miners of our peer group, having not had a single fatality since we first started mining and not one LTI in over 2 years. The West Kenya project is essentially a bigger and much better version of Shanta's new Luika mine. The West Kenya project today hosts 1.2 million ounces of inferred resources at 12.6 grams a ton. The target is a 3 million ounce deposit. That's the exploration target. Now, while the potential size is exciting, the grade is completely unique. Now, consider the oxides, which could be mined in an open pit. There is, just at one of the deposits, there's 135,000 ounces of compliant resources that sit within a pit shell at the Azulu deposit. And the grade is 43 grams a ton of that open pit material. 43 grams a ton. We've never seen a better open pit grade anywhere. The next best that we can find is a polymetal mine in Russia called the Avlaya Khan deposit, which hosts 175,000 ounces at 18 grams a ton. So it's a very, very exciting district that we are in. Now, in terms of the transaction rationale, this project fits very neatly into our portfolio and is in Shanta's sweet spot. It's in East Africa. We share a language with Kenya. It's underground long hole open stoping. It's the same mining method that we deploy. And geologically, it is essentially an extension of Tanzania's gold fields. We have a specific angle in long hole open stoping. We know what it costs to mine a project in this part of the world in-house. All of our Tanzanian peers contracted out. I think the second point to mention here is that the deal was essentially priced when gold was just over $1,200 an ounce. So in summary, using Shanta's costs and a gold price in the realm of where it is today, the majority of Shanta's NPV could in fact soon be in Kenya. To summarize the transaction terms, Shanta will pay $14.5 million this summer. $7 million is in cash, equivalent to just over 1 month of our Q1 EBITDA. $7.5 million will be paid through the issue of new Shanta shares, and Barrick will become a 6% shareholder in Shanta. In other words, minimal dilution to our shareholders. We think this is a truly transformational acquisition with many catalysts along the way for the share price. And we're looking forward to updating the market this summer when we expect the transaction to complete. Eric, back to you.
Thanks, Luke. I'll now take you through 3 slides on the asset, and then we'll open up to a couple of questions. But just starting here on slide 11, what we did was benchmark the asset quality, so in fact the grade, against some similar projects around the world. And what we like so much about high asset quality, and particularly grade, is profitability. The West Kenya project, as a standalone, will ultimately be more profitable, take less capex, and be more attractive than what we're already doing in Tanzania. This chart speaks for itself. Grading here is an inferred resource, 12.6 grams per ton, against some relevant benchmarks around the world. This is a slide I wanted to show you that got our geologists very excited last summer during our due diligence. This is very unusual, and amongst the gold benchmarks around the world is incredibly rare. Here's a picture of the core that came out of the West Kenya project during the $55 million that was spent over the last 6 years from the previous owner. A third of all the drill core that goes into the resource estimate of 1.2 million ounces has visible gold. 60% of those holes have multiple occurrences of visible gold. Simply unheard of, very rare, and it was exactly what got our geologists jumping up and down during the site visit at Kisumu. In terms of what this project might look like, the 1.2 million ounces is currently split mostly across the Azulu deposit, which is a larger brother to the Bushingala deposit. The high-grade ounces start immediately at surface, go through about 100 to 150 meters of oxide and transition ore, then into the fresh rock, which is what you see here. The potential to lower the capital, which we've said previously is about $125 million to build this, which is very doable in this market, is possibly deferred or compensated by the starter pits that Luke referred to earlier. As Luke mentioned, the potential for 3 million ounces is real. We've identified numerous areas that will be subject to further drilling, and it wouldn't surprise me if this 1.2 million ounce resource extends and expands further. What next? What should you as an investor be thinking about over the next 1, 3, 6 months even? Well, in terms of the catalysts, I'll start with the Singida project, and then I'll move over to the Kenya project to give you a feel for what you could expect. From Singida, as I said, we will be declaring an updated resource, independently signed off, with the reserve shortly. We'll be publishing updated economics that we think are significantly better than what we published in 2018. And these are all things we've said previously on analyst calls. We will be sharing our views on how Singida will be ultimately put into production and how it will be financed, which won't be from Topco equity. A lot of work has been ongoing at the Singida project since January 1st, and we're excited by sharing that update, or those updates, with you shortly. Now moving on to Kenya. We aim to complete the transaction and take full control of the asset around the middle of the year. So assume July 1st, which could move, obviously be sooner or slightly later than that. Following taking control, we'll start sharing some of the drilling data that we have, which is very exciting and is the backbone, the foundation to some of these resource estimates that have been prepared. Now, core to all this is a scoping study that we're currently working on and have been updating from the previous owner. We're excited by that, and we aim to publish that not too soon thereafter completing the transaction. Next year, or possibly even before then, towards the end of this year, we'll be moving towards drilling infill drilling, updating the resource, and ideally and ultimately moving towards a reserve. With that, I'll end the official presentation now and open up to any questions.
Okay, Eric, Luke, hopefully you can both hear me both. Thank you very much indeed. We do have a number of questions to get through. I'll try and take a reasonably logical order with them. Again, apologies if I don't get to your question. You've sent one in. And let's start with Kenya and the transaction, if we may. What would be the main risks to completion on that transaction?
It's a good question. There's two approvals in country. First one's competition approval, which is customary. We don't envisage any issues there. We've had an initial submission which didn't have any challenges, and it'll be going to a formal submission, I believe, later this month. The second approval is an approval by the Mining Commission, and that work is ongoing now. It's currently sitting in front of the Mineral Rights Board, and will ultimately be approved by the Cabinet Secretary of Mines. My last trip before the lockdown was in Kenya. I was there at the start of March. I met with the Permanent Secretary, the Cabinet Secretary, and the Chairman of the Mineral Rights Board, and I'm confident that we'll get these approvals in place, and we've said towards the middle of the year.
I've had a few questions in the same, but in a few different ways. But effectively, if the project's so compelling, why are Barrick selling it?
That's a great question. It's one we get so very often. Barrick's minimum threshold for what they define as a tier 1 asset is an asset that produces 500,000 ounces per year and has a minimum 10-year mine life. This asset in Kenya will not produce 500,000 ounces per year. We've said it is probably somewhere around 100,000 ounces per year, subject to final confirmation in our scoping study. And simply is just non-core for Barrick. It is far too small for what is a $50 billion company to be spending time on.
And then if we may, moving across to Tanzania, and again, a question that I'm sure you get asked a lot, kind of country and political risk, given what happened with Acacia Mining. Can you just talk to your relationship with the regime there and how you see your participation?
No, it's a good question. We do get that a lot. First off, what I can say is the situation around Acacia was very specific to Acacia. What you saw after Acacia was no longer independent, so it was part of Barrick Gold. A number of things. You had the positive resolution with the government in terms of their 50-50 agreement. You had a lifting of the export concentrate ban, which had been in place for more than 2 years. And there's an easing of the relationship generally, we believe, with Barrick and the government in Tanzania. We understand it's strong and getting stronger. In terms of our relationship in country, we've been operating in Tanzania for 19 years. We've been producing gold for 8 of those years. We are nearly fully indigenized. We currently have 99.4% of our workforce is Tanzanian. We pay Tanzanian tax. Last year we paid $23 million of tax and royalties. And we have a very open relationship with the government. They want us there and we want to be there. The communities want us to be in situ. We employ 40% of our workforce from the surrounding communities. They want us there and we want to be there. So it's a very good relationship. It's healthy. There's a lot of transparency and trust, which goes a long way in working with your host government.
And we've got one here, which I assume is from a long-holding investor. Let's get the exact wording. It's about dilution, and he's saying since 2010, and there have been 6 occasions where you've issued new shares, and I guess a concern about future shareholder dilution. You mentioned about financing for Kenya. But again, could you talk a bit about the environment for financing and any future potential shareholder dilution?
Yeah, I mean, shareholder dilution is core to both Luke and I. I mean, we we are shareholders ourselves. In the current roles we've been in these CEO and CFO role, we haven't had to request money from shareholders, and yet the share price has responded well since we've taken over. I mean, I think it's up 250% over the last 2.5 years, obviously off a low base. We are motivated by share price. That is how we ultimately see the rewards of being involved in Shanta. And the way we think about financing is we like to think of it in terms of how do we progress the growth that we need to by maximizing the share price. The obvious way to do that is to use your own cash flow. And at these gold prices, that is very possible because we're generating so much cash flow. We're obviously approaching a net cash position very quickly, particularly at these gold prices. And it's something I'll be updating the market on towards the middle of the year as well, which frees up the ability to take on project debt for a project like Singida if we had to, or look at alternative sources of financing that aren't at the topco level of Shanta. So we have a lot of options, starting with our own cash flow.
And one specific question, this might be our last one, if I may, and it's talking about the where are we here? It's moved off my screen. In your current assets, in your 2019 accounts have gone down to just 39.38 or 39.38 million. Why have the asset numbers gone down? Is that clear what the question is?
I believe so. I mean, I'll answer and then Luke can fill us in. I mean, it might be referring to current assets on the balance sheet where the the VAT receivable was moved to non-current assets. I mean, that was we did that to be prudent and to be fair with the accounts. Luke, anything to add on that question?
Yeah, I think that's the key, to look at the non-current assets as well.
So is it the case that you due some back tax receipts from the government? Is that right?
Yeah, so there's what's referred to as a VAT receivable. So within our market cap, the government owes us, I think at the end of Q1 was about $23 million. And last year, at the end of the year, we were successful in recovering $7.5 million of that. So the remainder is a receivable to Shanta. We believe it will come. We've had a lot of advice on this. We're working closely with the Revenue Authority and the government. And most importantly, Barrick is now working on its own behalf to resolve this in country. And so we're confident that there'll be ongoing resolution to this receivable over time.
Okay. Well, Eric, Luke, both thank you very much indeed for joining us this evening.